We're going to go ahead and start off this video with what Tom Lee said today about the recent sell-off.
Great to have you back. Welcome.
Yeah, great to see you.
Why do you say overreaction?
Well, yesterday really was an indiscriminate selling day. Did Tesla's valuation and fundamentals drop 15%? Did the broad market have a 4% decline in valuations? To us, it really looked like a lot of liquidation. I think investors are, of course, reacting to the White House warning of pain ahead, but it has been more of an equity sell-off than it has been in corporate bonds. So to us, 4% down days, I think it's an overreaction.
Yeah, how do you best explain that difference between what equities have done and what we've seen in IG and even high yield?
Well, I think on the stock side, markets are now saying, look, the new regime is we have to take the tariffs seriously. Now we don't know how long these tariffs might be. Will it hurt growth? And we've seen cuts from economists. But the bond market is saying, well, you know what? This is a growth scare. But the Fed is also now in a position to begin cutting because inflation pressures are abating. So I think the bond market is sort of pricing in a Fed put. The stock market saying, I'm not sure if there's a White House put, and then the Fed's on hold, and I think that's the divergence.
So which one should we be listening to?
Well, I think the Fed put, in fact, is probably coming back because the odds of a May cut have been inching up. They hit 54% yesterday. And, in fact, total cuts hit 3.5 cuts, which is now 2.5 or 1.5 more than the Fed's guided. But I think that the Trump put exists. I mean, I know they've explicitly said there isn't one, but look at yesterday. Tesla's down 15%, and on Truth Social, Donald Trump talks about Tesla. So I think a put exists. We just don't know the level when the White House intervenes, and then today's the Business Roundtable. We'll find out.
He does, but then he kind of ratchets up the dialogue as it pertains to the trade war this morning on Truth Social, regardless of all of the headlines surrounding tariffs and the trade war and what it means for growth and what it means for the market reaction.
That's right. And for a while, markets ignored those tariff headlines, and now they're taking it very seriously. But I think at the end of the day, if we take every headline at face value, then markets are completely paralyzed. And of course, that again creates opportunity because at some level, all these stocks are really attractive opportunities, especially something that's had a 50% drawdown.
I mean, you can talk about the NASDAQ being an overreaction at a 4% down day, but Tesla was up $500 billion in 2 months at the end of last year. I mean, was that an overreaction to the upside? This is what we're trying to figure out, right?
Yeah.
Where do we start out with in terms of valuation and investor expectations coming into this period when it's become a little bit more noisy?
Yeah, well, there used to be this term a while ago called rage selling, and I think these days with instant liquidity, markets have rage selling. And I think it's not just individual. I think institutions push a button and go flat. So I think that, we're getting whipsawed these days. And I don't know where to titrate that. Like, was Tesla worth double what it was compared to November, and now is it worth half? I'm not sure, but I think it's somewhere in between.
Meantime, there's still a lot of desk notes about CTA supply and the next 5 days. There's plenty to sell. Are you buyer that even if we bounce today, it's going to be more of a process?
Well, I think positioning does tell us we're stretched to the downside, and we know markets are oversold, and we know sentiment's bad. I guess the real tell is we need to have follow through because last week felt like we could be bottoming, and we failed Monday. But do I think that a 10% correction shouldn't happen? I mean, this is like the 6th correction of 8% or more since 2022, so it is pretty garden variety. But, getting down more than 10% to me is like we've got proof of a recession. And I think that that's why the data points next few weeks are going to matter.
Yeah. So if we do draw down 10, you'll want to talk again.
Yes.
Okay. Tom,
We're
thanks.
close, yeah.
Well, maybe before. Tom Lee, thanks so much.
Ladies and gentlemen, we have lots of breaking news to go over here in this video. Trump comments as pretty typical. White House press secretary also said some things that moved markets. The trade war with Canada is escalating. Peace in Ukraine could be closer than ever. And the S&P hits a technical 10% correction before bouncing from the lows of the day today. We have economic data and CPI coming out tomorrow. I will share insights with you about all of it. Ladies and gentlemen, Let's get into it. Now, also in the news today, Canada's Prime Minister, Designate Carney, Trump's escalation is an attack on the country's workers. And he does say that Canada will keep tariffs until the U.S. commits to free and fair trade. And he says that Canada would maintain the tariffs on the U.S. until Americans, quote, show us respect. There was also news today that Canada is threatening to turn off or stop the power supply to New York, Michigan, and Minnesota, which would be a really bad problem. I mean, I feel bad for what the U.S. would do to Canada if that happens. So let's hope level heads prevail here. White House press secretary says Doug Ford's comments were egregious and assaulting in regards to shutting off power to Americans. Trump is determined to ensure U.S. depends on American electricity. And the White House, aka Donald Trump, says Canada would be wise to not shut off electricity for Americans. The White House says Canada has always been an ally. Perhaps they are becoming a competitor now. And Canada's energy minister says, I'm concerned about steel tariff impacts. Some of the big positive news today for markets, the U.S. State Department said Ukraine expressed a readiness to accept the U.S. proposal to enact an immediate and interim 30-day ceasefire. This is as they are working on the critical minerals deal. And credit default swaps on the U.S. 1-year, essentially, bonds rises to 45 basis points, the highest since November 5th. According to S&P's global data. This means a credit default swap really became popular with 08, 09. That's how Michael Burry used to, short the mortgage market. Essentially, it's saying there's a 0.45% chance that the U.S. defaults in the next year. That's still a very low, risk. And it really comes down to the funding deal for March 15th and the debt ceiling limit that still looks like it has not been raised. And Ontario's Doug Ford warns of a Trump recession and threatens, again, that electrical shutoff. Trump said earlier this morning that we will substantially increase tariffs on cars coming into the U.S. on April 2nd if other tariffs are not dropped by Canada. And Trump will shortly be declaring a national emergency on electricity. And Trump says, based on Ontario, Canada's placing of a 25% tariff on electricity coming into the United States, I have instructed my Secretary of Commerce to add an additional 25% tariff to 50% on all steel and aluminum coming into the United States from Canada. Now, steel is not a huge issue, but most of the aluminum we get comes from Quebec. So that is a bigger issue. And Trump says that we are subsidizing Canada to the tune of more than $200 billion a year. Why? This cannot continue. The only thing that makes sense is for Canada to become our cherished 51st state. This would make all tariffs and everything else totally disappear. So the trade war doesn't look like it's ending anytime soon unless Canada becomes the 51st state, which they say will never happen. And Citi strategists today, or essentially analysts, downgraded U.S. equities to neutral from overweight, which it had been since October 2023, while upgrading China to overweight from neutral. They say that U.S. exceptionalism is at least on pause. The strategists tell investors in a research note the firm believes the news flow from the U.S. economy is likely to undershoot the rest of the world in the coming months. At least tactically, U.S. exceptionalism is therefore unlikely to roar back. Citi predicts it thinks China stocks screen well even after the recent rally. And White House Press Secretary Leavitt says we are in a period of economic transition, which essentially means we're going into a recession. And she says that stock market numbers are a snapshot of a moment in time. Now, the Iranian president said this to Trump, quote, I won't even negotiate with you under threats. Do whatever the hell you want. And it is official. The S&P 500 falls 10% from the record high, now set to enter a correction. And according to the CNN Fear and Greed Index, we are now at 14 with all of your components in extreme fear, besides junk bond demand that is in greed. And the percent of stocks trading above their 50-day moving average down to 23.2%. About 2% of stocks today are falling below their 50-day moving average. So it just continues to be a rough market. Here on the day today, the Dow is down 1.7%, down over 700 points today. S&P is down 1.46%, NASDAQ down 1.15%, Russell down 0.5%. The VIX is up 3.63% today to about 29. But again, you're still really not in that panic moment. You still have not seen that mass capitulation where everyone is rushing into puts. That just has not happened yet. Oil is up 0.5% today. 10-year treasury yields are up 1.5 basis points, and gold is up around 1%. Now, as far as economic data today, we did get the JOLTS job openings numbers that came in at 7.74 million. We were expecting around 7.63 million. So this number did come in higher than expected. Generally a sign the labor market is holding up, but it is kind of working with a lag because these numbers are for January. We're now in March. So it's really the February numbers that are going to reflect more of the uncertainty from tariffs, the decline in overall business activity. So I don't think this tells us too much, but it did relax potentially some of the fears of a recession today. Again, with more of your risk on areas doing a little bit better versus consumer staples, as I showed, that are really lagging behind. Now, the NFIB Business Optimism Survey came in 2.1 points lower than where you were a month ago, coming in at 100.7 in February, marking the lowest level since October of 2024, just before the election, and coming in below market expectations of 101. So you came in a little bit weaker than expected. It says, additionally, the uncertainty index surged by 4 points to 104, reaching its second highest level on record. So the uncertainty that business leaders are faced with is almost the highest level on record. Small business owners' expectations for improved business conditions over the next 6 months declined. So business owners expecting the economy to essentially get worse, and the percentage viewing the current period as a good time to expand also decreased, though it remains well above fall 2024 levels. Inflation continues to be a major concern, ranking second behind the top issue, labor quality. Coming out tomorrow morning, we will get CPI for February. Now, we're expecting core month over month. That's really the important one that Wall Street cares about most, at 0.3%, but there is a rounding effect here. So you could come in at 0.25%, or you could come in at 0.34%. Those numbers are very different, but they still round to 0.3%. So if we come in line with expectations at 0.3%, you actually want to figure out what the unrounded number is, because that'll tell you a little bit more of whether it's a good or a bad print. Last month, you came in at 0.4%. So you really want to see a number lower than that. I mean, another 0.4% print would be problematic. Now, year over year core CPI is expected at 3.2%, down from 3.3% last month. Headline month over month expected at 0.3%. Given the decline in oil prices, overall energy prices, you could actually see that one come down more than expected. And your headline year over year rate is expected at 2.9% versus last month at 3%. And it's pretty straightforward and simple. Lower CPI is good. Higher CPI is bad. And meeting expectations is probably a nothing burger. Okay? Nothing has changed when it comes to CPI, even though we're still in this whole, recession scare trade. Now, with that said, if inflation comes in high again tomorrow, then you're going to bring up more fears about stagflation, and that's a whole other can of worms. And let's hope that doesn't happen tomorrow. Now, we will also get around noon tomorrow a 10-year treasury auction, and that will move the 10-year treasury that'll move like TLT, so that can also move yields around in conjunction with CPI. Now, my personal opinion, I think CPI is probably going to come in a little bit lower than expected. I don't know if it's going to be a huge, beat to the downside. But I think CPI is probably going to come in a little bit lower than expected, especially as the economy has been weakening, as consumers have been slowing down. That's typically a disinflation or deflationary environment. It could take some more time to get that actually reflected in the data, but I do think numbers are going to come in a little on the weaker side tomorrow for CPI. And that could help fuel a bounce in markets. You did see a bounce from the lows today, and from the all-time high until right now, you are down about 9.16%. At the low of the day today, you were down about 10%. You almost exactly fell 10% from high to low. So who knows if this is going to mark a short-term bottom. CPI, I think, is really going to be the catalyst for that, if that is the case. Now, is that the ultimate bottom for 2025? Probably not. It seems like the trade war is going to continue. The government's telling you you're going into a recession. Scott Bessent, Trump, and even the White House secretary today, press secretary, said we're going through a transition period or quote unquote detox period. That is a fancy way of saying you're going into a recession. Okay. You're going into a reset period. I don't think I want to fight that. I don't think I want to try to time when the data is going to continue to get worse or not. I can tell you though, right now, we're not priced for a recession when you look at the headline markets. Okay. Markets would fall a lot more if we do go into a recession. With the government telling you you're going into a recession, I don't exactly want to fight that. But I do think it is time to start, nibbling, right? You do want to invest in 10% corrections, as scary as it might seem, because in the odd chance that the White House, Trump, Scott Bessent are wrong and we don't go into a recession, you don't want to not be able to take advantage of a 10% correction and subsequent recovery. So just my thoughts, again, the ultimate bottom for markets could be somewhere around 500 on the SPY. If we did go into recession, you're going to fall more than that. And that's where the problem is. You're looking at more than 10% downside from here, in my opinion, if we did go into recession. But just getting back to new all-time highs from here is going to be pretty difficult if the economy is slowing without Trump, and the whole tariff regime, trade war ending. It's going to be pretty hard to get investors over the hump here of what tariffs are going to do to the economy. And to get you like 6,200 on the SPY is kind of a stretch in the current setup that we have. So just my thoughts. Again, let me know your thoughts down below in the comment section. We are due for a bounce with the RSI now oversold, sitting at 29. So it wouldn't surprise me if this is a short-term bounce, but I wouldn't be fooled. I don't think it's the ultimate bottom for markets. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.